People have to be very careful how they look at the markets, because when you get too much Bitcoin sitting in a concentrated set of hands, when those hands make a decision and move, things can happen that are disproportionately more violent than otherwise. Now, what's interesting is what's going to happen, I would say, in the next 6 to 12 months is we'll see a whole series of derivative financial instruments, which will allow people to trade essentially risk and hedge risk in the ways people can do around other commodities. Bitcoin trades purely based on the sentiment people have in its value and its scarcity. And when you see Bitcoin move, it has 2 times the volatility of an S&P or a NASDAQ, but look at how fast it bounces back. Nobody runs Bitcoin. Right? This is the purity, the beauty of Bitcoin as an investment asset. And this is why governments should feel comfortable investing in Bitcoin.
Fred Thiel begins by addressing one of the most significant risks facing the Bitcoin market: liquidity risk. Unlike traditional markets, where liquidity is more abundant, Bitcoin operates in a relatively thinly traded environment. Thiel points out that the market for Bitcoin can be segmented into the open market, exemplified by platforms like Coinbase, and the over-the-counter OTC market. Exchange-traded funds ETF, which are gaining popularity, operate on a T+1 basis. This means that when an investor buys shares in a Bitcoin ETF, the actual purchase of Bitcoin happens after the market closes or the following day. This delay introduces a unique risk, as the price of Bitcoin can fluctuate significantly between the time of the share purchase and the actual acquisition of Bitcoin by the ETF. Thiel anticipates the emergence of a range of derivative financial instruments in the next 6 to 12 months. These instruments will allow investors to hedge against risks in the Bitcoin market. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think the biggest risk is a market liquidity risk. Right? So you can kind of think of it this way. You have the open market, right? The Coinbases of the world. And then you have the OTC market. The ETFs essentially operate on a T+1 basis. So if you go buy shares in an ETF on Monday, they go into the market and buy Bitcoin after market close or the next day, and it settles the next trading day. And so if you buy shares on Friday, then they're doing buys on Monday, which means what happens to Bitcoin over the weekend can influence the price of the Bitcoin that they buy on Monday. And there's a lot of trading around that. As the volume of Bitcoin in ETFs grows, and you think about how many retail investors operate, bad news, stock exchange drops, the NASDAQ, S&P 500, whatever, drop 10%. Well, if they decide to sell 10% of their holdings in Bitcoin all at the same time, the market is still fairly thinly traded in the open market. And so you will likely see a bigger drop when there's a drop. And the OTC desks may not have the capacity to absorb that volume. And so people have to be very careful how they look at the markets, because when you get too much Bitcoin sitting in a concentrated set of hands, when those hands make a decision and move, things can happen that are disproportionately more violent than otherwise. Now, what's interesting is what's going to happen, I would say, in the next 6 to 12 months is we'll see a whole series of derivative financial instruments, which will allow people to trade essentially risk and hedge risk in the ways people can do around other commodities. In the oil industry, there's all sorts of ways you can do things to hedge your risk. And so we're going to start seeing more and more of that around Bitcoin as a way to create a much more liquid market. Because imagine a future where the US government owns 2 million Bitcoin. That's 10% of the available Bitcoin. Saudis, Russians, Chinese, India, et cetera, decide to own 20% in aggregate. Okay, now that's 30% of all the Bitcoin in the world has suddenly just is off the market. So that leaves 70%. And you could argue that roughly 4 million Bitcoin, the keys are lost. I mean, Satoshi's wallet, stuff like that, right? Okay, so that's another 20-ish percent. So now you're at 50% of the Bitcoin is kind of locked up. And then throw the ETFs in there, you know, already at 1 or 2%, MicroStrategy, you know, 1% and growing. Okay, so now you're kind of at 60%. Not a lot of liquidity in the market. And so you either have to get in now, or it's going to get a lot harder. And you know, the market's going to have this roaring demand for these derivative instruments. And so you're going to see the actual liquidity speculating on Bitcoin as an investment asset grow exponentially over the next few years. But there's a very unique aspect to Bitcoin, which I don't think a lot of people realize. And that is that with other commodities, they can be consumed, right? Gold is consumed for industrial purposes, jewelry, et cetera. Oil is consumed, metals, et cetera. And with financial instruments like stocks, they're driven based on the performance of the companies that the shares represent. And, you know, this argument that people have had for years that, well, Bitcoin isn't backed by anything. Bitcoin doesn't represent anything. Here's the beauty of that. And that is that Bitcoin trades purely based on the sentiment people have in its value and its scarcity, period. That's it. And so it's a much more pure form of investment. And when you see Bitcoin move, yeah, it has 2 times the volatility of an S&P or a NASDAQ, but look at how fast it bounces back, right? If Tesla produces bad numbers, the stock drops, you have to wait till the next earnings before the stock likely starts rolling back up again. Mt. Gox, or the state, the German state that sold all this Bitcoin a couple of weeks ago, price dropped, came right back up. Right? You look at the dips we've had and the amount of volume of Bitcoin that's gone into the market that's been absorbed quickly, and the prices come right back up. Yeah. That speaks to the amount of demand there is for Bitcoin. And that speaks to the health of the Bitcoin liquidity market today. Right? And I think that the concept we've had of these cycles that we've had before, 4-year cycles, and you know, the miners are going to capitulate. The miners' impact on the price of Bitcoin today is insignificant, other than miners holding a lot of Bitcoin and selling. But the amount of Bitcoin miners produce daily that is sold into the market is becoming a more and more insignificant piece of the equation. And so that leaves just pure supply and demand. And the best thing about Bitcoin, you know, and I'm the first person to say, you invest in Marathon stock, you're investing in the management team and my capability to run the company. Nobody runs Bitcoin. Right? Yeah. This is the purity, the beauty of Bitcoin as an investment asset. And this is why governments should feel comfortable investing in Bitcoin, because nobody controls it. Yes. Right? Yeah. It's down to pure supply and demand or market sentiment.
The potential decentralization of Bitcoin mining as more countries recognize the strategic importance of holding Bitcoin. He suggests that every country that wants to hold Bitcoin will also want to have Bitcoin mining operations within its borders. This could lead to a significant decentralization of mining activities, forcing miners to become more efficient and competitive. The implications of this shift could be profound, reshaping the landscape of Bitcoin mining and further solidifying Bitcoin's role as a global reserve asset.
The U.S. is the single largest holder of gold in the world. The dollar's not backed by gold, but gold allows the U.S. to project power into financial markets. Other countries hold gold as their reserve. And actually, it was the holding of gold that drove Nixon to decouple the dollar from gold, because other countries were withdrawing their gold from the U.S. system because they saw the spending that was going on at that period of time, and they thought the U.S. would go bankrupt. So the U.S. government holds a lot of gold. They're the largest landowner in this country. They own about 28% of the land in the country. And what recently happened was the expiration of the petrodollar, which was this agreement where the commodity producers would price their commodity in dollars in protection for, in exchange for protection from the U.S., and then they would invest that in treasuries. Right? That's now gone. And so we've seen the U.S. as a reserve currency drop in significance, and it's now down sub 50% as a holding asset. The Chinese now buy gold instead of treasuries. Japan, which was one of the biggest buyers of U.S. treasuries as they were going through their recent financial situation, have now also tapered. Comically, one of the largest buyers of treasury bills, which are short-term, is Tether. Right? They're the sixth largest buyer. They buy at a nation-state level.
How ironic.
Right? And so the U.S. needs to fund its debt somehow. And if people aren't buying dollars or putting things in dollars, that is a precarious situation. So that leaves the U.S. with only a couple of alternatives. They either have to let the dollar drop in value significantly and have high inflation so they can inflate away the debt, but that would be disastrous. The other thing they can do is they can invest in an asset like Bitcoin, which will over time appreciate in value. And if it can appreciate at a rate faster than the U.S. total debt appreciates, then now you have something you can use to offset the debt over time. And if the U.S. were to hold 2 million Bitcoin, and that Bitcoin goes to $20 million over 10, 20, 30 years, then now all of a sudden the U.S. would be holding at $20 million, roughly 40 trillion plus. Well, the federal debt today is 35 trillion and growing. And there's no way the government can service that debt at current inflation levels, interest rate levels.
Yeah.
Right? And so the minute the U.S. does it, they will now have the ability to project power in the Bitcoin market because they will have pricing power because of their supply, just like they do with the Strategic Petroleum Reserve. Why does the administration sell oil out of the Strategic Petroleum Reserve? To drop the price of gasoline, to lower inflation. Right? Why does the Strategic Petroleum Reserve exist? Well, it was to protect us from price shocks in the outside market. Well, today the U.S. is arguably the largest oil producer in the world. And so they have the ability to not suffer the consequences of high international oil prices in the same way. But if the U.S. does it, then everybody else is going to have to do it, because you can't be a country and not have a strategic reserve of Bitcoin if all the other countries have it.
Right.
And countries like Russia, China, and others look at Bitcoin as a neutral currency that isn't controlled by a government or a country, that allows them to trade independent of any sanctions the U.S. would ever do. And so if the U.S. wants to keep them from trading in violation of sanctions, they have to also have enough Bitcoin so they can impact that market. And so it becomes an issue of national security, which has nothing to do with cybersecurity or anything like that. And when President Trump talks about we should have all Bitcoin mining in the U.S., part of that is a thinking that if you have Bitcoin mining in the U.S., then you have the ability to determine what transactions get processed, which is why every single sovereign who wants to hold Bitcoin is going to want to have mining in their country, and which is why they're all going to want to operate their own mining pools so that you can't essentially, through sanctions, OFAC, et cetera, control their ability to transact in Bitcoin. So the implications of Bitcoin becoming a sovereign reserve asset are that every country in the world who wants to hold Bitcoin should have Bitcoin mining in it, which will lead to a huge decentralization of Bitcoin mining. Right? And that will force Bitcoin miners to have to become super efficient at what they do.
Fred Thiel's analysis provides a comprehensive view of Bitcoin's future as both an investment asset and a strategic tool for governments. As Bitcoin continues to evolve, its impact on global finance and geopolitics will become increasingly significant. Investors and policymakers alike must stay informed and prepared for the challenges and opportunities that lie ahead. In a world where Bitcoin could become a cornerstone of national security and financial strategy, the decisions made today will shape the landscape for years to come. Please like and subscribe my channel.